Hey everybody, happy Friday, October 18th. This is Rick Mount with Fairway Independent Mortgage. Wanted to bring you this week's quick market update and let you know what's going on out there in the world as it relates to mortgage finance and interest rates. Well, after 16 days, the president signed the deal and has ordered furlough employees back to work. With the temporary deal, the government can remain open until January 15th, and the debt ceiling would not be reached again until February 7th. So, oh boy, I can't wait to see how these guys deal with this issue again. Essentially, we've just kicked the can down the street and drawn the line in the sand, but just a little further down the road. The financial ratings agency Standard & Poor's came out and said Wednesday that the shutdown has cost the American economy roughly $24 billion. That's around $1.5 billion per day. And as a result, it would be a reduction in our GDP, or gross domestic product growth, of 0.6%. So it's obviously going to have a significant impact on the closing out of the fourth quarter here as we move forward and putting a drain on the economic recovery that we've been experiencing. So on a brighter note, though, as a result of the deal and the fact that the government is going to be less incited to stop or taper their spending to keep rates low as a result of the negative impact the government shutdown is going to have on the economy, interest rates have actually seen a rally. So the mortgage-backed securities and the Treasury note market have actually enjoyed a nice rally, recouping much of the losses they've suffered since the middle of May. With that being said, it puts the 30-year fixed conventional rates down in the low 4s, and a lot of the ARM products such as the 5-1 or 7 ARMs in the high 3s, low 2s. So bringing back a lot of affordability, again helping the purchase market with a little bit of stimulus there, as many buyers that would have been priced out of it with the recent rate increases are now back in the game, and as a result many people are now back in the refinance game who may have missed the boat before. There's also another segment of the population that's benefiting this time around with the low rates, and that's people that may have taken out an FHA mortgage with mortgage insurance or a conventional loan that required mortgage insurance. As a result of the newfound equity they've had over the last 12 months, many of these people now have values necessary where they can qualify for a traditional loan that would not require mortgage insurance. So with the low rates and the newfound equity, it's opening up a whole new form of stimulus where many people can save money on the recent transactions over the few years. I think it's important to always keep perspective, though. We've gotten spoiled and somewhat accustomed to super low interest rates over the last several years, but historically speaking, an average 30-year fix typically has ranged just below 8%. That's a historical average going back to the mid-1970s through today. So you can see if we're just below 8% as a historical average with rates near the low 4% range, we're almost half of what a historical average would be. Low rates equal affordability. So with that being said, we always want to offer a little bit of perspective about where we're at in the scheme of things. So there's a lot going on in the market out there. If we can help you with any way, keep in mind that we take a financial planning approach to real estate lending, which means we want to make sure that you make a healthy decision both short-term and long-term, and are here to provide the consultation to help you do so. If we can help you or anybody you know, we look forward to working with you. Have a great week. We'll see you soon.